probably the most fundamental lesson of investing, which is that you don't really choose the returns that you want. You can think you're choosing the returns that you want, but really what you're doing is choosing the risks that you are willing to take, and the returns are sort of the result set of the risks that you choose.
How long before I lose my job to AI? What's your estimate?
There will be roles that will be displaced through AI, but I think the folks that learn how to leverage it for their own benefit, that's the key.
Wylie Tollette, Executive Vice President and Chief Investment Officer at Franklin Templeton. Wylie's had a fantastic career that's taken him from a 24-year-old CPA managing a $300 million bond portfolio during the savings and loan crisis to leading investment operations at CalPERS, the largest public pension fund in the US.
Probably the most dramatic shift has been an opportunity for mispricing in the public markets has continued to shrink. The way I think Peter Bernstein said it well, he said markets can get mispriced at a macro level, and it takes millions of investors moving at the same time to reset prices at a macro level.
This is The Blonde Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blonde Dollar. Today we're joined by Wylie Tollette, Executive Vice President and Chief Investment Officer at Franklin Templeton Investment Solutions. Wylie's had a fantastic career that's taken him from a 24-year-old CPA managing a $300 million bond portfolio during the savings and loan crisis to leading investment operations at CalPERS, the largest public pension fund in the US, to now overseeing multi-asset investment strategy at one of the world's largest asset managers, Franklin Templeton. Along the way, he's worked across investment risk, performance analytics, governance, asset allocation, and built and led teams through periods of real market turbulence. In this episode, we'll talk about the new rules of asset allocation, how investors should be thinking about markets, and the role asset owners should play in an AI-driven world. We'll also get personal, of course. We'll talk about his path into finance, the sailing dream that almost stole him away, and what winemaking, surfing, and mountain biking in Santa Cruz can teach us about risk resilience and staying grounded in volatile times. So whether you're a CIO, an advisor, or just someone trying to figure out where the hell we go from here, this one's packed with wisdom, perspective, and hopefully some good laughs too. Wylie, it's an absolute pleasure to have you on the show. Welcome to The Blonde Dollar.
Thank you, Ignacio. Happy to be here.
Thank you. And before we dig into all of these topics, quick promotional ad. I'd say the reason why Wylie and I are talking today is because the CFA Institute put us in touch. Why? Well, because we're both going to be attending the CFA Institute Live Summit in Chicago from the 4th till the 7th of May. It's going to be absolutely amazing. We're going to have over 1,200 finance professionals talking about some of the major themes currently shaping markets. So if you work in the industry and are into meeting other interesting people, make sure you come. Wylie is going to be there. I'm going to be there. And there's going to be many others attending too. So make sure to check out the event online, CFA Institute Live Chicago from the 4th till the 7th of May. So Wylie, I suggest we start by talking about you. What is it that you do exactly today?
Yes, I lead a team. We have about 140 folks located in 12 different locations around the globe, managing multi-asset portfolios for retail, institutional endowments, foundations, pension funds, mutual funds, ETFs around the world. And it's been a fantastic experience.
Can you maybe walk us a little bit through your career journey? You've had a fascinating non-linear path. I'd say you did accounting, then you went to risk, then performance, and ultimately now you're in the C-suite. How did you go basically from from accounting to leading a huge investment team at Franklin Templeton?
Yeah, that's a great question. It definitely a nonlinear path. I look back on it and it sort of makes sense. It seems to all connect, but at the time, of course, it was just making decisions that seemed like the right ones at the time. But so really, my initial path into investment started. I was working for KPMG, a big accounting firm, and it was the tail end of the savings and loan crisis, as you mentioned, in the U.S., and it was 1994, and excuse me, it was 1991, and we had the federal government brought us in to basically replace the staff of a very large savings and loan that had failed. So KPMG was brought in, and in the first morning we're there, they literally sort of asked all of us what you would like to do. And someone said, well, who's going to manage the bank's investment portfolio? And I shot my arm up because it's always interested me. And so later that afternoon, I was literally responsible for managing about a $300 million sort of liquid assets portfolio that the bank had, because they had let go of the previous staff. And frankly, I didn't know what I was doing. So I had to I had to basically give myself a crash course in investing. I bought books, went home and just read, studied everything I could. This is pre-internet, so books were the key, and tried to learn from some of the staff that was still there, and basically, we did okay, I have to say. I'm proud of myself for not buckling under the pressure, but that was my first taste of investing, and it really hooked me at that point. And then in '94, that's when Franklin Templeton was really growing quickly. I started in the San Mateo office and then very quickly moved to the Rancho Cordova, California office, which is near Sacramento, and they had opened that office because basically in response to the earthquake in 1989, they wanted another site that was sort of less earthquake prone, so that they could recover operations if they needed to. And so started there and basically stayed for, well, it's been 30 years elapsed time if you kind of take away my 4 years at CalPERS.
Wow. So it's not like you were 7 years old and you said, "I want to be the CIO of a big asset manager." It.
No, I didn't. I really didn't. I honestly, at the time, I think I joined Franklin when I was 27, and I think I got sort of the role managing the bank's liquid assets portfolio when I was 24, 25. So I was literally just a kid, and I didn't really know which sort of path to take. And maybe that's a good lesson for other folks that are earlier in their careers that aren't exactly sure if they're on the right path or know which direction to go, which is, I look back on it now and it all makes sense. But at the time, I remember thinking, I don't know which way I want to go, but this feels like the right direction and decision. It was kind of more of a gut feel thing, really.
What I think is super cool with your profile is how you've done like many different things that kind of give you a 360 view of the asset management business. I don't think there's many CIOs out there that have such a wide range of experiences. So I wanted to ask you, what are some of the biggest lessons that you've learned along the way that shape the way you lead today? That you learned from doing all these different jobs over the years.
Yeah, that's that's a very sort of kind way to put it. It looks like a sort of a career assembled through a lot of different steps. But yeah, so when I joined Franklin, I was in the fund accounting department, and that really taught me basically how markets work because we had to price every security and every fund every day. It's thousands of securities, and some which were easy to price, just pull the prices right off the market, and some which were tough. So I quickly learned, that a lot of sort of alpha, excess return, lives in the corners of the markets that are less well covered, that where prices are harder to find, where the opportunity for mispricing is greater. And this is back in the '90s, and frankly, there was still quite a bit of mispricing to be found in sort of the darker corners of the market, the more illiquid parts, high yield bonds at the time, for example. small cap stocks. There was just a lot of opportunity to find mispriced securities, buy them cheap or sell them high, and that was a neat opportunity to see early in my career. And then I started to work in the technology group, helping to implement investment technology at Franklin. And I got the responsibility to roll out a global trading system because Franklin had been growing through acquisition and buying all these different companies, and they were all over the world. And there was some concern that something was going to happen in some far reaches of the planet, and it was going to cause a scandal, or we were going to have a trading event that we didn't know about. So we implemented a global trading system, and that got me, a front row seat with literally every portfolio manager and trader in the whole company. And that's where I learned all the different styles of investing, the different approaches, some more quantitative, some more fundamental, some very seat of the pants. Again, this is early 2000s, like 2001, 2002. Part of that actually also included implementing a trading system for our high net worth subsidiary, which happened to be located in the World Trade Center. And so I spent quite a bit of time in the World Trade Center in New York in 2001. Obviously, I was not there on 9/11, but many of my friends were, which was a very difficult day.
Mm.
And then having to recover that part of our company right after 9/11 was one of the most memorable and formative experiences of my career. And I really saw how people rallied to try to get things up and running, how people were able to jump into other jobs that they needed to do. And really, what that taught me was sort of a sense of entrepreneurial spirit, like just get the job done. Yeah, there was a saying at the time, which was, "He who sees the snake must kill it," uh, which was a good lesson to learn because it was just a matter of the people that sort of knew how to do things. We just had to do them and get it done quickly to recover from that. Following that, I got an opportunity to build out the investment risk function, which really I just
Mhm.
so enjoyed. That was about 2004. And I ran the investment risk function. I built and ran the investment risk function at Franklin until 2014. And that really taught me really probably the most fundamental lesson of investing, which is that you don't really choose the returns that you want. You can think you're choosing the returns that you want, but really what you're doing is choosing the risks that you are willing to take. And the returns are sort of the result set of the risks that you choose. And, you know, across the spectrum of risks, you name them: market risk, currency risk, you know, uh, systemic risk, uh, interest rate risk. There's just uh, uh, risk is a fascinating subject, and I came away from that with kind of a little saying, which is, um, the risks that you're taking, they should be uh, recognized, rational, and rewarded. And recognize means, they should be intended. You should understand the risk. Not Don't take unintended risks. That's very, very common in our business.
Mhm.
Uh, Rational means sized appropriately, and basically not. You want risks that aren't going to basically sink you if it doesn't go your way, but are going to benefit you if they do go your way. So that means sizing them correctly. And
Mhm.
rewarded means they have the opportunity to be compensated. There are risks that you can take where literally the opportunity for compensation is not there. So why take it? And that really carried me into CalPERS,
Mhm.
and I worked on something very similar when I got to CalPERS, but I'm sure that's another question.
Yeah, that's pretty cool. And I want to bounce on that risk part of the conversation that you were alluding to. What is the risk that is the hardest to price, in your opinion, from all your years of experience?
Illiquidity. Illiquidity is really tough, and it's very prevalent in the markets. I I had some experience with illiquid assets uh, at uh, at Franklin Templeton, as I mentioned, but we were primarily invested in the public markets. So illiquidity was usually in those sort of darker corners of the public markets that I
Mm.
mentioned earlier, like high yield bonds or things like that. Or through the financial crisis, we certainly saw illiquidity, in CLOs and CMBS and a variety of other securities that really where basically liquidity dried up. But moving to CalPERS, of course, the vast majority of the active risk is in the illiquid portfolio, the private markets.
Mhm.
Fascinating portfolio. CalPERS owns everything. They own timberland. They own, at the time, we had a few vineyards in the in the portfolio. They own real estate across the world in a wide variety of locations and different types of real estate. They owned private credit, uh, infrastructure, toll roads, power grids. So you can think airports. I think at the time we were there, we owned part of Gatwick Airport in London. So it was just a fascinating portfolio, but understanding and trying to estimate like the prices of things and like how and if you could actually sell them if you needed to
Yeah.
um, was just tremendously challenging, and it
Mm.
remains a challenge.
Yeah, that's one of the big criticisms of private assets today, right? Like the lack of price discovery and the lack of mark to market,
Yes,
which
that's right.
is a good thing or a bad thing, depending who you ask and how you look at it, I guess.
Yeah, it's a facet, Ignacio. You've just nailed one of the most fascinating conversations that we had when I was at CalPERS, and I was privileged. I was privileged to be part of it. And basically, a lot of the private, and I had never heard this perspective, but a lot of the folks that were experts at investing in the private markets, uh, their contention, and they had some good arguments for this, is that the private markets actually were a better gauge of long-term value. That the public markets, that stock markets, exchanges, bond markets, they were too twitchy. They were too subject to human emotion
Hmm.
and frailty and bias. That really that was not the correct way to judge value because it was too volatile,
Mm.
and it really wasn't a good for a long-term investor like CalPERS. It really wasn't a good gauge of long-term value. Yeah, whereas the private markets that weren't priced daily, priced quarterly or annually based on appraisals and actual transactions, which were infrequent, was actually a better, obviously less frequent, and perhaps less. I think that obviously, if you're a quantitative person, the amount of data that you have to chew on in the private markets is pretty scanty compared to what you can get in the public markets. But uh, it was just really a fact, and there was no clear answer to that question. Who was right? Were the private markets folks right, saying that that long-term value and long-term appreciation opportunity was a better gauge of value than the because they had some good points. The public markets are twitchy. They
Hmm.
can be subject, to daily news flow, and if you sell it today, who's to say that tomorrow you couldn't sell it for twice as much just based on a few, tweets from somebody? And so they really did have a point.
Mm. I also love that you talked about liquidity. I was hoping you would talk about that. I'm a fixed income advisor. So for me, liquidity risk is one of the big ones. I always like to say that liquidity is one of those things that no one talks about until it's literally the only thing that everyone talks about, right?
Yes, exactly. That is exactly right. And when it's not there, but that's the other thing I think, and you're quite familiar with this if you're familiar with fixed income markets. It can be there in spades on Monday and be completely absent on Tuesday, um, just based on based on the way markets work.
Mm.
And there's it's just a fascinating thing. And I look at liquidity risk in the fixed income markets actually today as one of sort of the what I call like canaries in the coal mine when for market stress. If you see fixed income liquidity and some of the further reaches in the fixed income markets, high yield bonds or you know sort of floating rate notes, things like that. When liquidity in those dries up, that is usually a pretty good indication that the market, the broader market, is going to start to see some stress.
Yeah. I also think it's really hard to measure liquidity risk in fixed income markets. There's no perfect indicator. I mean, as you know, and as our listeners probably will know, uh, public bonds are like traded over the counter, the
Yes.
those listed. So it's tough. Like there's some people trying to create some indicators. Like there's that liquidity indicator, for example, that Bloomberg created. You can also look at bid offer spreads. You can look at outstanding amounts for bonds and so on and so forth. But as you were saying, like sometimes all of these look fine and all of a sudden you try to place a trade and no one's on the other side, and you just figure it out on the spot when you're trying to place the order. So it's a tough one, but I also find it really fascinating, and part of the beauty of particularly of the asset class I work in, which is fixed income.
I would agree with that completely, everything you said. And, it's actually that's been one of the interesting stories over the last several years. It is just sort of the resurgence of fixed income as an asset class. When I was at CalPERS from 2014 to 2018, I think the 10-year treasury was trading somewhere in the twos, and so it was pretty modest returns. And after inflation, it was basically zero. Um, and so, really, what I saw was just people really trying to move away from fixed income. Um, it was still a diversifier. It still had sort of the portfolio insurance component to it, particularly sovereign bonds. But from a return perspective, it was pretty measly, and so folks were generally trying to allocate into other parts of the market, privates, even just ramping up equity allocations. What's been kind of nice and a bit of return to my earlier career back in the early '90s when I first started investing in fixed income. When the 10-year treasury was somewhere between 5 and 6 and 7, somewhere in that neighborhood. We're not there right now, but we at least have much more attractive yields across much of the fixed income market. Still not fantastic, but at least you're getting some compensation for your investment in fixed income, along with the portfolio insurance component.
I like to say, but of course I may be biased here, that fixed income is the most beautiful of asset classes. I don't know if you agree with that, but I find it's like a very complete, very rounded asset class because you need to know about the companies or the governments that are issuing the debt, but also you need to know a lot about macro and interest rates, obviously, because there's a direct impact and correlation between rates and bond prices. Plus you have this illiquidity that we were talking about, and the fact that it's over the counter. It makes it a little bit more complex, a little bit more technical, and I think it's really fun, honestly. And on top of that, you can play, you can make investments in all sorts of economic environments, during bull markets, during bear markets. So I think it's a really, really interesting, really cool asset class, quite frankly.
I do too. I actually agree with you. I started my career in fixed income, as I mentioned earlier, and what I one of the things I like about fixed income is it has a mathematical elegance to it, really, where if you know the maturity of a bond and the yield and the current going rate, you can basically sort of unpack the expected returns.
Mhm.
And even to this day, like if you want to know the best estimate for the long-term return, say a 10-year return on a US Treasury bond, use the current 10-year Treasury yield. It's a pretty good estimate of what you're going to earn over that 10 years.
Mhm.
There are very few other asset classes where you have that type of indicator
Yeah.
that is as reliable.
The visibility of a future cash flows. That's really, really
That's right.
cool.
That's right. Yeah.
Absolutely. Go team fixed income. Let's go.
I know. It's good to have some people speaking up for it because for so long it was sort of the unloved asset class. But as I mentioned, I'm really pleased to see that it's kind of come back into the forefront.
Yeah. So going back to your role as a CIO, you've always obviously worked with some of the most or very, very talented portfolio managers and analysts. And I was wondering, beyond raw skill, what actually creates a high performing investment team? In your experience, what separates like the best in class investment teams from just good ones? Hey there, quick favor to ask. If you enjoy the blunt dollar, The unfiltered takes, the stories, and the laughs. The easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Excellent question, and I've thought quite a bit about that. And what there's a couple of things that come to mind, and I think it was actually Michael Jordan, famous U.S. basketball player of my younger era, that said that gr- great players win games, great teams win championships.
Mm.
And so I really look for, and this has been an evolution during my career too. When I first started, it was still the era of kind of the star portfolio manager, where you had individual portfolio managers that were like mini celebrities. The end of like Peter Lynch comes to mind from the 80s and 90s at Fidelity. And even at Franklin, when I started, Mark Mobius was one of our. I worked closely with Mark, and he was kind of a celebrity portfolio manager in the emerging
Before
markets.
Ashmore?
That's right. Yeah, yeah,
Nice.
yeah. He was at Templeton, and so. But what I've seen is a evolution, and I actually think it's quite a healthy evolution to where really focusing on people, process, and technology, kind of in that order. So the people, get the best people that you can, uh, but make sure that they're team players. You don't want gigantic egos or folks that really want to become a celebrity, because that can be very disruptive if you're actually trying to build a team-based investment approach. Process, look at the investment process, the decision-making process that you use. Because I grew up in risk and performance attribution, that's where I always start, which is what are the risks? What are the risks that we're taking? How much active risk? How much total risk? What types of risk? Factors, factors, countries, concentration, liquidity, all the different types of risks that you're taking, both total and active relative to the benchmark that you're trying to beat. And then understand on a very regular basis through performance attribution whether those risks that you're taking are actually you're getting paid for them. Are you getting compensated? Is your decision making process sound? And if it's not, go back up into it and fix it. So that's process. And then finally, technology. Increasingly, and I've seen this evolve through my career as well, that technology is becoming essential. Like finance and technology are basically weaving into one common thing. And AI is only bringing that further down the path. But basically, you really can't basically expect to compete, much less beat your benchmark or beat your peers, unless you have good technology on your side. It's essentially got to be part of the team from the very inception. And so we've really focused on that at Franklin Investment Solutions, and we've leveraged an internal platform, building one. I've been working on this for years, from the time I first started working on the trading platform at Franklin Templeton years ago.
I
More
love
than
it.
22 or 23 years ago, we started working on this. So technology's got to be part of the team.
100%. I mean, well, I think you're spot on. People, processes, and technology. And I think even if you just have two out of the three, it's not gonna work. Like
Not going to
if you
work.
want to have a superstar team, you need the three of them. And by the way, bouncing on what you were saying, two things come to mind. First of all, you were talking about Michael Jordan. If you listeners don't know who Michael Jordan is, please stop listening to this podcast and go check him online. There's a very good Netflix documentary. I think it's called The Last Dance. I don't know if you've seen
The
it.
Last Dance. Oh, it's excellent, isn't it? Yeah, I've
Yeah,
watched it a couple of times. I love it.
about the Chicago Bulls during the Michael Jordan era. Even if you're not into basketball, definitely worth the look. And the other comment, you were talking about Mark Mobius, absolute legend within the world of emerging markets investing. I need to get him on the show in some. I need to reach out to him in some way, because I think he would be the perfect guest. He must have like crazy stories also from all the decades he's been in the industry.
Oh yeah, so had that when I was head of risk at Franklin. I had a chance, as you can imagine. Mark took some investment risks in different parts of the world, and so there was a number of years where, when I was in charge of risk, I would travel with that team and attend their annual conferences. All some of the most interesting places I've ever been, in the Philippines and
Mm.
Turkey and Vietnam. And anyway, I also got a chance to know Mark, and he's a fascinating, uh, one of the people I admire the most in terms of just the way they conduct themselves personally. I would get to the gym in the morning at the hotel, like at 6:30, and Mark would have already have been there for an hour. He
Hmm.
For, someone in their late 70s, 80s at the time, he was just in fantastic shape. He kept an amazing schedule. I don't know how he did it, but just a really neat guy. I have a lot of admiration for him.
Absolutely impressive, and yeah, very, very knowledgeable about
By the way,
emerging
I still
markets.
keep in touch with Mark, so maybe I'll try to pass along your email address to
Oh,
Mark if he's
100%.
interested. Yeah.
Let's see if this conversation goes well, and if you like it,
Oh, there you go.
I'll
Yeah.
take it. I'll take it. So I need to deliver, and I need to perform.
There
Um,
you go.
but yeah, thanks for offering that. I appreciate it a lot. So I, I I mean I want to go back again to you as a CIO. We keep diverging from that because there's a
Yeah.
lot of interesting topics, but um, so I wanted to ask you if, I mean, you've clearly seen the financial industry evolve and go through massive changes over the last few decades, not only in terms of technology, but also because of regulation, demographics, the emergence of new asset classes, and so on. What's one major shift in the industry that you've witnessed, that you've experienced in your own skin, that has challenged you as a leader during these past few decades, and how did you navigate the situation?
Yeah, great question. And I would say probably the most dramatic shift has been, and apologies to all of those sort of public market active managers out there. But what I've seen, because of technology, efficiency, the number of folks trying to participate in the markets, is that the opportunity for mispricing in the public markets over my 30-year career
Mm.
just has continued to shrink. There is just the way, I think Peter Bernstein said it well. He said, markets can get mispriced at a macro level, and it takes millions of investors moving at the same time to reset prices at a macro level. You can think those are widespread market shifts when we have capitulation across huge market, across a huge swath of asset classes. That's that type of shift. But micro mispricing, micro efficiency is so much higher now than it was when I started. And you think about all the algorithms, all of the bots, all of the AI engines, all of the people with Bloombergs, in their garage, trying to squeeze the last bit of juice from those lemons out in the public markets. There is just not that much mispricing to be extracted. It's still there, but boy, is it tough to do it once you think about fees. So in the public markets, and we kind of came to that conclusion for the most part at CalPERS, which was, the CalPERS portfolio. Even while I was there, we really evolved it from having a lot of external active public markets managers in stocks and bonds, and basically shrank that list because so few of them over the long term were able to really generate positive alpha to cover their fees. And so it became largely a giant index portfolio on the public markets. There's still a few, and there's still a few managers out there that are kind of still remarkably good at finding alpha. But boy, they're few and far between. A
Mm.
lot of, and what I've also seen during my career is just how private markets have taken over a lot of that active risk and a lot of that active return. And so, again, that CalPERS portfolio, thinking about how it's built, a lot of the active risk and almost all of the fee budget is really allocated to the private markets. And that's probably appropriate, although the fees are high. In many cases, the sort of the returns justified at least some of that. I think we will see fee compression. That's probably the other big trend that I've seen during my 30 years is incredible fee compression, primarily in the public markets, and that will occur in the private markets as well, I think, over time. But there's still a long way to go there.
It's funny because you've been referring to, yeah, the fact that it's getting harder because of less and less price inefficiencies and things like that. I started working in the early 2010s, and the only market I knew was already pretty efficient, you know? So when I hear these stories about the opportunities that was in the past, I'm like, wow, I would
Yeah.
have loved to be around at the time. It must have been really, really fun.
Yes, I think that it really was fun when I first started. There really were just many more opportunities. There was
Mm,
also a lot of unrecognized risks because we didn't have all of the tools, and factor models were just coming into the picture, and so we were probably taking risks we didn't necessarily know about. So if we were getting compensated, we thought we were getting compensated because we were so brilliant at finding a mispriced security, but chances are we were just taking a risk we hadn't yet
mhm,
properly measured. Now we can probably measure them pretty well, but as a result, the opportunity, kind of the paradox of our industry, is that the better you can measure something, usually the less opportunity there is for mispricing in that market.
mm,
And so again, that's why so much of the opportunity set has moved into the private markets. And we've seen that as well as the number of listings. You can just see the number of, listings say in the New York Stock Exchange, for example, is, basically been on the decline for many years. And a lot of that activity, a lot of that capital has flown into the private market. And maybe I'll also just quickly mention, I also think that's one of the most interesting sort of near-term opportunities. There's also some risks involved, but to see private markets move from really an institution-only type of playground to see private market investments begin to move into sort of down market, into retirement plans or into wealth, individual wealth portfolios, individual investor portfolios.
mhm.
I'd like to see that. There's important diversification that can be had, say in core real estate. The trick is to make sure that the fees are reasonable and that people understand the liquidity, and they can't have their money right away, and that's going to be a bit of a shift. But there really are diversification opportunities, I think, that people should avail themselves. And now there's tools in the marketplace, things like interval funds and auction funds, and where you know people that aren't that aren't investing at the scale of CalPERS will be able to access those types of investments going forward.
So let's talk a bit about CalPERS, because obviously, I mean, you're not working there anymore, but you spent a few years over there.
I did.
Um, Obviously, I mean, a huge institutional investor, over $400 billion in assets under management, and obviously often in the spotlight, not only because of the sheer volume of assets managed, but also because they're shaping governance, ESG, and asset owner behavior that many others follow. What was it like working at CalPERS, and what stands out most from your time there?
Yeah. First of all, it was I was there for 4 years, and the way I describe it, is kind of a tour of duty. I left Franklin and I came back to
Hmm.
Franklin, and I did sort of my tour of duty, at
Public service.
CalPERS in the public service, exactly. And I actually I went to University of California, so I, live here, so I actually did feel a sense of responsibility. I was never in the military, so I kind of looked at it a little bit like my military service. Um Paying back the state to a certain extent. And that 4 years was a fantastic, education in investing and across every possible type of asset, as I mentioned earlier. That I loved. I also loved the people in the investment office. They were great and learned a lot from many of them. The other educational element was that I learned how politics work, and I learned how state government works. Uh, and that part of the job I didn't love. I'll just uh, Politics is a messy business, and the intersection of money and politics can be very tricky. Uh, what I observed was that many times, a particular politician wanted to make a point or get on the news or had a particular sort of bone to pick, and they would use divestment. Uh, they would pick on CalPERS and say, "We need you to divest from something," because they wanted to make a point. And so there was a lot of work involved in having to sort of fight off constant divestment bills because, and I think from a politician's standpoint, divestment feels like the right thing. You should sell those Turkish bonds. Um, that was a very consistent refrain from some of the lobbies in California to not invest in Turkey at the time. Um, but the challenge is that, first of all, it doesn't there's always another buyer. You're not really affecting the thing that you want to affect. And and you're potentially damaging the diversification of the portfolio at the same time. So divestment is really a tricky thing. And
Mm.
right now the state is still under pressure to divest from oil and gas producers. Um, but what I observed was many of the folks lobbying CalPERS to divest from oil and gas producers drove a gasoline-powered automobile to the meeting. So I don't know. There was just a lot of that element of the job was just very tricky to navigate. But the investing part was fantastic and fun.
Yeah, that's one of the things that clearly comes to mind when I think about that job that you had at CalPERS, like how to deal with all the different stakeholders, because you have on one side retirees and taxpayers, but then as you said, you have politicians, legislators, and so on the other, and obviously each group has different objectives, different times horizons, so you need to to be good in both worlds, and clearly not easy. So yeah, kudos to you on going through that. Not an easy job by any means.
Definitely not. It built muscles that I didn't know I needed to build, particularly on sort of how to navigate complicated political situations. I
Mm.
made some just, terrible mistakes, and every board meeting was, broadcast live and then recorded on YouTube. So if you want to see my mistakes, they're all out there in the public record
Mm.
on YouTube. You can watch them all. And, but over the course of the 4 years, I think I finally made enough mistakes to learn what not to do, and was able to navigate it reasonably well. But never. I don't think anyone could ever claim to be an expert. There's just so many complex issues
Mm.
going on there.
And how did you deal with with transparency? Because obviously, being a public institution, you have super high expectations in terms of transparency, but sometimes explaining complex investment strategies, uh, especially to non-specialists, can be very challenging. How did you balance that? Those dynamics between being transparent on one side and not overwhelming with people with a lack of technical expertise on the other. Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah, that is a great question, Ignacio. And I would say that, like, I felt it part of your responsibility in those senior roles at CalPERS is y- you 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 really have to uh, believe and understand and commit to helping your constituents, your stakeholders, understand what you're doing in language that isn't patronizing. You know what I mean? Or
Mhm.
isn't you really have to commit to it. And just because you're using simple language to describe an investment, uh, doesn't mean that the people that are, listening are simple. It just means that it's not their field of expertise. So you many times just had to use simple language, but that's really an art. And again, that's one of the things that I got better at. I don't think I was ever great at it, but I really do feel like CalPERS has a good commitment to transparency. I was inspired by their commitment to transparency. Just the idea that, if we're investing money on behalf of the state of California, on behalf of the pensioners, on behalf of the taxpayers, you have a responsibility to make sure that people understand what you're doing. You can't keep it secret. You got to be upfront about it to the extent you can be. And I think we did a pretty good job of that. I mean, like I said, there's always room for improvement, but I think CalPERS is actually one of the more transparent large public institutions out there. I mean, if you look at uh, in it's a completely different scenario, but many of the sovereign wealth funds in the world are not very transparent because they view a lot of that transparency as sort of potentially damaging to their strategy or to their investment returns. They want to
Mhm.
keep things a little closer to the vest, and I understand that. But that's a slightly different mission. CalPERS mission is to really, pay pensions over the long term for the employees of the state of California. So uh, you're investing on behalf of literally the entire public, and so you really have to think of that as your audience.
Yeah, fascinating at times, and I also find really interesting that that you left Franklin and then you came back. That must have been it must have been weird, but you, I guess when you came back, it must have been like home at the same
A
time
little
because
bit,
you knew
yes,
people, you knew processes, you knew the institution.
I did. I definitely did. And what was interesting in the 4 years that I was gone, 24, I was at CalPERS from 2014 through 2018. Uh, the the industry, the investment industry, had been dealing with some pretty dramatic changes, in Franklin in particular. So, for example, um, the world had started to move away from traditional mutual funds and moved towards ETFs. ETFs were they were still a relatively new product. They weren't they were growing rapidly, but still smaller than mutual funds. By the time I came back, ETFs were clearly in the lead and were the product of the future, and that's still the case, at least in the U.S., where mutual funds have some tax disadvantages that ETFs don't have. And Franklin was a little late to the ETF game. They're catching up rapidly, which is great. And we work with the ETF team at Franklin to help, support them. And we have several ETFs that my team helps manage. Um, but that's one big shift that happened during that 4 years. The other big shift was in the retail marketplace is that much of the world moved from sort of a commission-based sales approach in the retail or the advisor-driven distribution to advice fees or like paying an annual or quarterly fee and away from commission. And that's a very different sort of distribution structure and sales structure. And then finally, as I mentioned, um, the interest in private markets during that 4 years was really dramatic. We saw just a dramatic uptick in interest in real estate, private credit, private debt, private equity during the 4 years I was away. So when we came back, Franklin embarked, I think it was smart, embarked on an effort to try to build out their alternatives investment management capabilities, and they've done that. And I think that was smart. But obviously, a lot of competition out there. A lot of there's a lot of a lot of good investors. I actually think, and I'll just, this is one of their sort of editorial comment that I'll just quickly mention, which is this is a good time to be an asset owner.
Mm.
Compared to many years in the past, there is hyper competition in the investment management space. Fees are coming down. And I think fees are going to come down in the private markets as well, given again that hyper competition. It's a good time to be an asset owner. It's a very challenging time to be an asset manager.
Mm.
Uh, and so if you're on the asset owner side of the equation, I think you have a lot of opportunity. Really, the world is sort of your oyster.
You were talking about ETFs. I have a question about ETFs. I'd love to get your perspective on because we're seeing the rise of something called active ETFs, which sounds a bit of a paradox because ETFs are have historically been as known as the quintessential passive investment trackers of indices and things like that. And now all of a sudden they're adding this new type of product, which is like, okay, it's an ETF, but it's somehow actively managed and there's a little bit more liquidity than on a mutual fund and so on. What do you think about active ETFs? What's your stance?
Yeah, I think we're going to continue to see those grow, and I think that we we manage active and passive ETFs within my team, and Franklin offers both. I think that'll continue to grow, and there's a variety of different ways to do it. There's sort of semi-transparent active ETFs. There's fully transparent active ETFs. Um, and whether it's packaged in a mutual fund or packaged in a ETF form, active returns over the long term in the public markets are really, really challenging. And so the slightly lower fees and slightly lower tax drag that an ETF has can actually be an advantage over a a similar strategy mutual fund. So I actually think active ETFs are gonna be the predominant one of the predominant ways that people access active management in the public markets going forward.
Yeah, they've been getting definitely loads of traction in the past couple of
Yep,
years.
that's
Um,
right.
I wanna go back to the three bullet points you gave before: people, processes, and technology. The third one, very topic very close to my heart, particularly AI. I'm a big fan. I'm trying to, become part of the new generation of financial advisors that is familiar with all these tools. I wanna become part of the wave of change and hopefully stay relevant in the future
Yeah,
workforce. So I have a few questions around this topic. First of all, how is technology and specifically AI, which is the big buzzword at the moment, changing the way asset owners and you at Franklin specifically work and make decisions today?
absolutely. I'm equally excited about it, even though I've been in the industry a while and I'm, starting to bump up against 60 years old. I too am doing my best to try to stay current on AI tools. I've got a couple of them that I use regularly. And I'd say that, at least in my team, we first started using them sort of almost like a job aid. Obviously ChatGPT or Claude can write pretty well, and and give you a very solid sort of first draft if you're actually just doing writing.
Mm.
Uh, we s- I still think they need some work when it comes to numbers. That's one of the things I've noticed. They're better at language. I mean, they're large language models. They're better at language than they are at numbers still, although that's changing quickly, very quickly. Um, Once we started to use them sort of as job aids to try to do some writing for us and take minutes at meetings and summarize emails and things like that, which were just sort of efficiency generators. We've actually now started to use them actually as sort of investment assistants. And let me describe what I'm talking about. Is I mentioned earlier this tool that we're building as our multi-asset comprehensive multi-asset platform. It's called Mosaic, and which kind of describes the way it's built. It's a mosaic of different capabilities. And one of those capabilities is actually a little robot that we're building in there called Pixel. And it's an AI little robot that kind of watches what you're doing in the system and makes suggestions, makes investment suggestions, makes process suggestions to you. And so that's what I was mentioning when I mentioned people, process, and technology. Like technology has got to be part of the team. You really have to think of it kind of on equal playing field in terms of how to build a world class investment process. Technologies really a key pillar there, and increasingly that includes the use of AI agents. And Pixel is our agent, and he's excuse me they we have not chosen a gender for Pixel. Uh, that's Pixel's decision, and Pixel is just he kind of a part of the Mosaic platform. He's just watching and helping.
Is
And
Pixel
I can
sentient already?
Yeah, Pixel's watching. I don't think I could describe him as fully sentient. Like, I don't think he's not independent yet. He's still more like an assistant than a full-fledged investor. But there will be a day, and he's learning every day. There will be a day where Pixel, basically probably wants to take on his own portfolio.
So let's stop there for a second because that's super interesting. So how far away do you think we are from truly tech driven, AI driven portfolio management? Do you think, and do you even think that's possible at some point, or is the human oversight always going to be needed?
I don't think we're far away. In fact, today, even currently, we have portfolios that are systematically driven. In fact, the vast majority of our equity assets are managed using
Hmm.
systematic equity factor models, and those are basically, you know, rules-driven tools that help select securities. Uh, and those rules are built based on analysis of a tremendous amount of historical economic data, company data, earnings data
Yeah.
that helps us build rules that help us select securities and build portfolios. So those are in existence today and have been for a while. In terms of like sentient AI managers making decisions on portfolios without human oversight, I think we'll see it in the next 2 to 3 years.
Oh, wow.
I mean, yeah, I don't think it's that far away at all because they learn so quickly. That's both the beauty and kind of the scary thing is that they just learn so quickly. And But as I said, there's still work to do in terms of numbers. Like I've
Mm,
just noticed the large language models are great at language, at summarization, at sort of pulling together massive amounts of information and making it consumable. They're still not that. What I've noticed is, in general, this is a bit of a generalization, but they're still not that great all the time at analyzing numbers and coming up with the right answer. They'll come up with an answer, but you have to check it very
yeah.
carefully, and
Yeah.
particularly when you're talking about other people's money, checking it twice is really important. You don't want to trust the AI agents on that front just
Mm.
as yet, but I think within the next few years, it'll come to fruition.
So how long before I lose my job to AI? What's your estimate?
I don't think you'll lose your job to AI. I can tell you're young enough and smart enough. I think what you will do is you will have an army of AI agents that work for you, that make you more effective. And I think that's the key. People, uh, you know, uh, there will be roles that will be displaced through AI, but I think the folks that learn how to leverage it for their own benefit are the ones that are going to, really thrive in the next generation of our economy.
I'm an optimist too. Um,
Yeah.
I
Good.
fully believe in the potential. I like to look at it glass half full. I think AI won't replace me, but someone using AI could. So I wanna stay
That's right.
current on it
That's right.
and have an army of, as you say, agents and minions doing all the small tasks for me. That would be amazing.
Yeah, wouldn't it? Exactly.
So as we get closer to the end of the conversation, I'd like to wrap it up with a few personal questions, maybe a bit of advice. So first of all, a piece of advice for the next generation. What's something you wish you had known earlier in your career?
Something I'd known earlier in my career. I knew this in my career, and I made a point of making it a priority in all of my roles. But if I could go back, I probably would have even bumped it further up the priority list, which is really focusing on building relationships with people. And I know it sounds like a cliche. It sounds like just so obvious, and for some people, it's just a natural thing. But um, I think it's just so important that as you progress through a career, you're going to meet hundreds and hundreds of people, and like just go back to the basics. Be trustworthy, be honest, be a good friend, be someone that people can count on. That is so important over the long run because you're going to accumulate relationships that are really going to define your life. You spend so much time at work and so much time, you know, it's the majority of your life really is spent at work, and so make it meaningful. Obviously, at work, those work relationships, it's a slightly different type of relationship than a personal relationship, than a true friend you've had since college or something, or obviously a spouse or something like that. But those relationships are tremendously important, and you can carry them with you throughout your career. So that would be one thing that I would suggest. And many people focus on the technical components, and you have to do that. That's kind of the back wheel of your career. Your CFA or your CPA or your Kaya, chartered alternative investment analyst types of things, and those are obviously important. They tell the world that you know the basics, the nuts and bolts. But it's really the relationships that can accelerate your career and accelerate your not just your career but your own personal growth.
Mm. Yeah, and I feel like in the finance industry, sometimes we tend to forget that because we spend so much time behind our Bloombergs and our Excel models and so on.
Yes,
But at the end of the day, it's a people's business, right? And yeah, 100% agree with you. Get out
that's
there
right.
and talk to people in real life.
Exactly. I think many people and are attracted to finance because it feels like you can kind of focus on the numbers and like not have to get into messy interpersonal stuff. Like sometimes I know, like sales, for example, those tend to be people, whereas in the investment group, those tend to be numbers people. But what I've just found is that uh, even the numbers people, if you can focus on kind of tilting your approach towards focusing on the people in a sincere way, I think that will pay off for you both personally and professionally over the long.
Mm. And tell me, like after all these years in the industry, what continues to energize you about your work? Is it like the people you're meeting, the way the markets are evolving and keeping you on your toes, or something
Yeah,
else?
that's a really good question. I've been examining that, Ignacio, because uh, like potential, retirement is not that far around the corner. But I don't think I'll ever fully retire because markets fascinate me. Part of the reason I'm attracted to this industry is they're always changing, specifically asset allocation is part of the reason that I work in a multi-asset team, because asset allocation has always just fascinated me. uh, I'm endlessly curious about it. There's new asset classes bubbling up all the time. And I think that evaluating them and thinking about them and thinking about what they add to the risk and return of a typical diversified portfolio is just fascinating. And maybe part of the reason is because there's no way to do asset allocation passively. There's no such thing as a passive asset allocation. There's a passive U.S. equity portfolio. There's potentially a passive, fixed income portfolio, but there's no such thing as sort of a perfect passive asset allocation because every asset allocation is built around the objectives of the investor, and those are always different. You can construct them using passive vehicles, but the asset allocation has always got to be an active decision, and that's why it's just something that I've always found interesting. And I think I always will. I'm endlessly curious about that.
You're an investor at heart, and you will
Yeah.
always be. I love it. Um, for those of you that want to follow your thinking and stay updated or on what you're doing and what your team is doing, where's the best place to find you and find more information?
Oh, you bet. The solutions team, FT at Franklin Templeton Investment Solutions, we publish on a monthly basis something called allocation views, and it's available on our website. And every month, it basically talks about where we think opportunities lie, as well as where the risks lie. Um, we're dynamic asset allocators. In other words, we believe that you can add to risk and return by leaning a little bit one way or the other into stocks or away from stocks in different regions, countries, fixed income sectors. We're not swinging for the fences in those types of bets, but we are leaning one way or the other, and and we publish that on a monthly basis. And we have quite a few followers. It's a well-read document, so I definitely advise people to take a look at that.
You heard it, freely available online. So make sure to check
Indeed.
it out. And
Please.
one last question, the most important question: did you catch some waves today? Are you gonna catch
No,
some?
that's next. That's next. Yeah, it's quite early here in California, uh, but I think it's I think our conversation was set for 7 a.m. So actually, that's the best time to be out there because there's fewer people and you can catch the peak. Uh,
Sorry,
but
sorry to have you
no,
here
no
instead of
worries.
in
I'm
the
happy.
on the water.
That's next. That's the next thing on my agenda is to head out to see if I can't catch a few waves.
Amazing. Wiley, it's been absolutely a pleasure to have you on the Blunt Dollars. Thank you for all those honest takes, for sharing all those insights and advice. And I really look forward to see you in Chicago.
Very good. Thanks, Ignacio. It's been great fun to talk to you.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production, comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.